everyone. Thank you for joining us today for this special presentation on corporate finance stress restructuring and bankruptcy. My name is Alina, and I'm joined today by our professor, Dr. Wang, who's also our founding director of the Queen's Master of Finance Beijing program. Thank you for joining us today, Wei.
Okay, thank you, Alina.
So I will give you a brief introduction. So our professor, Dr. Wang, is an associate professor of finance and RPC fellow of finance at Smith School of Business at Queen's University. As I mentioned, he's the founding director of our Queen's Master of Finance Beijing program that we have in collaboration with Renmin University. Professor Wang's primary research expertise is in corporate restructuring, bankruptcy, leveraged finance, and high-yield bonds, as well as distressed investing. So today you have a little bit of a sneak peek in his research and his feedback on the corporate finance distress and bankruptcy. So I will give the word to you, A.
Okay, thank you. All right. So I think that today I was asked to provide an overview of my new book, but I thought I can use the opportunity to talk about leveraged finance markets and the restructuring the bankruptcy industry in general. So the purpose that hopefully the information I'll provide today will make you interested in this topic. I taught this course, a course on restructuring at different schools, including the Wharton School, Tax School of Business, UST. During those lectures, I realized actually, as an important topic, distress and restructuring is not well understood by many MBA students and undergrad students. So I thought this is a very important topic. This topic as a course being offered and in many top schools. So that's another reason why I decided to write a book with my co-authors on this topic. This is one of those topics that are very important, but not well understood by many people. But the bottom line is, when a company becomes financially distressed and seeks restructuring, this is where many different expertise comes together, such as the professionals from the financial industry, consulting, accountants, tax experts, turnaround specialists, and many other professionals will come together at one place. So let me just start to give you the cover of the book. The book was published in March this year by Wiley. And as you can see, this is the fourth edition because Professor Altman wrote the first edition in 1983, and then the other three editions, the two editions after that, in the next 20 to 30 years. And I joined as a new co-author to work on this fourth edition. We added many new chapters, and a lot of material in this book, in the new chapter at least, comes from my teaching notes and my own research in this field. So far, thousands of copies have been sold, from what I was told. People who bought, most people who bought this book are professionals working on Wall Street and the legal practice and so on. So this book has been, I think, a good reference to understanding key aspects and the perspectives on corporate financial distress, restructuring, and bankruptcy. Now, before I start, let me just talk about leveraged finance markets and why this is important. What's leveraged finance markets? Well, this is a market where high yield or risky firms are financed. Risky firms could be those that are rated low, say BB by S&P or BA by Moody's, and they face a high cost of financing. And in this market, we have two segments. One is leveraged loan market. The other is the high yield bond market. And this market is very important for financing risky companies for the operation and the growth and hopefully a turnaround. And also it's important to financiers, commercial banks, investment banks, and even today, as you know, many of the non-traditional lenders, such as CLOs, and mutual funds, hedge funds, they're active in this space. So before I talk about what do we do in this book, let me give you a snapshot I took from Standard & Poor's LCD. It shows the annual issuance of leveraged loans. As you can see, last year the issuance amount was at just over $600 billion, and as you can see, a large fraction of that came from financing by institutional investors, which is dark blue bars here. And the bank's participation is not as active as it used to be in the late 1990s. So really, this market now is dominated by institutional lenders. And as of today, I believe the outstanding amount for leveraged loan is about $1.1 to $1.2 trillion in total. The high yield bond, the annual issuance high yield bond is about $300 to $400 billion a year. And if you add up the outstanding amount as of today, which is about $1.7 to $1.8 trillion, the two markets together is worth more than $3 trillion. So if you think this is a small segment, I would say it's not. For $3 trillion value, this is huge. And I got to say, compared to 2007, right before the financial crisis, the outstanding amount of leveraged loan was only $500 billion. And today's amount is more than twice of that. So we're in a credit boom. I mean, we've been in a credit boom for the last 8 to 9 years, and this boom created a huge amount of high yield debt. Now, in an economic recession or downturn, many of these bonds and loans will be in a default state. But the question is, how to restructure or how to price, and even from the investor perspective, whether to invest in these securities or not. So the landscape for leveraged finance markets changed quite a bit. If you ask someone who haven't learned too much about this market, if they got their undergrad in the 80s or 90s, I guess their response for the loan market is, oh, you go to the bank, you get a loan. Or banks usually are lead lenders, and they take a large fraction of the loan to leverage the borrower. But today, the market's changed dramatically because, as I said, the institutional lenders now play a huge role in this market. So definitely there's a shift between traditional banking to institutional banking. And also the CLOs have been a very active player in this market. I think CLOs today in today's markets purchase around 60 to 70% of leveraged loans issued. Mutual funds take about 15, 20%, the rest of hedge funds and other lenders. And another feature that's changed quite a bit was the new type of loans known as the second lien or third lien loans. These are special type of loans that are secured, but only their rights are pretty much limited to whatever the first lien loans exercise the rights first. So these are secured, but not fully secured. So these are some of the new instruments created over the last 10 to 20 years. Covenant line loans, these are another special type. Today with the active involvement by institutional lenders who don't have strong incentive to monitor, but have strong incentive to seek yield, the covenant line loans become a popular type. These loans don't carry much financial covenants, but they do have the standard positive and negative covenants, but they just don't have the financial covenants that allow lenders to take control of the borrower if their financial condition deteriorates. Now, let's go to the bankruptcy filings. As I said, leveraged finance markets are important financing distressed companies. All these companies got a hit, let's say, when the economy goes to recession, many of these companies will go default, will file for bankruptcy. So in the U.S., we have Chapter 11, Chapter 7 filings. These are filings for reorganization and liquidation. As you can see, the filings are quite cyclical. In 2009, 2010, we have a spike. As of today, we're lowest in terms of the bankruptcy filings in history. Now, in the last 2 years, one industry that stands out in terms of the bankruptcy filings is the retail, the traditional, some of the brick and mortar department stores like Sears. This is due to consumer preference changes, the habit changes. Many of these firms, many famous brands went down. As you know, Toys R Us got liquidated. Forever 21 is the latest bankruptcy filing. So there are, for retailers at least, there are specific provisions by the bankruptcy code in the U.S. that can help them structure, at least survive, hopefully survive throughout the bankruptcy process. And also, in the last couple of years, from 2015 to 2018, energy industry has been another focus on distress side. So the industry, if you think about leveraged loan market, which is about $3 trillion, and the bankruptcy itself, together, this is a huge market now we call an industry. As I mentioned earlier, in bankruptcy, there are many things that got to be done, okay, by investment bankers, advisors, turnaround managers, accountants, and so on and so on. So this chart, actually taken from a book, lists the services that are required to help distressed companies restructure. So there are many jobs involved. As you can see, there's valuation, capital raising, negotiation, liquidation analysis, testimonials, pension issues, labor issues, audits, and so on and so on. So as I said earlier, this is a complex situation where many different players from the financial markets and legal side come together to work on an important issue. So this is what part one of our book covers. We start with leveraged financial markets to talk about leveraged loan and high yield bonds, and then we provide an overview of the bankruptcy process to talk about the important provisions of the bankruptcy process and why they're important to how companies restructure. And then we get to some important issues for distressed and bankrupt companies. These include how firms achieve private workouts, which is the outward restructuring, how to value distressed companies and bankrupt companies. One important issue here is tax. When a company files for bankruptcy, the carried tax benefits could bring huge valuation to the company if they can be retained. So there are some specific issues that professionals pay attention to when they value a bankrupt company. And there are corporate governance issues, the board, fiduciary duties, managers, and so on. Then there are labor unions, pension issues, how to renegotiate the contract, and also there are supplier issues, and so on and so on. In the end, we provide a chapter on international insolvency code. We cover a few countries besides the U.S. to compare the key features of their insolvency codes. So let's start with that's the first part of the book. Let's start with the second part. The second part focuses mostly on credit cycle and distressed investing. Now, what is credit cycle? The credit cycle is a cycle for financing typically high yield or low quality companies. Typically, we define this cycle as benign or stress credit cycle. The benign cycle, it's a time when it's not costly or the market liquid to finance high yield companies. borrowers. A stress cycle is where the financing cost is really high, liquidity dries up, and high-yield borrowers find it difficult to raise financing. So typically, we use 4 variables to describe a credit cycle to determine whether it's benign or stressed. The first one we use is the default rates of risky debt. Second one, recovery rates on defaulted debt. So these 2 parameters measure the 2 important dimensions on the default risk of risky debt. First of all, you're going to care about what's the likelihood of default. Then you need to worry about what's the recovery upon default. The third indicator is the yields or yield spreads of risky debt compared to riskless benchmark. This is about how costly it is to raise financing for a risky borrower. Then the last indicator will be liquidity of the market. So this chart is taken from pretty much my book, shows the default rates from 1972 to 2019, which is the second quarter. As you can see, the default cycle is quite cyclical. The yellow bars stand for recession periods. As you can see, during the last 3 recessions, the default rates pretty much went up to about 10% or higher for the risky bonds. In the 70s and 80s, they were lower because the high-yield bond market was not well developed until late 1980s when the LBO took off. So you can see over the last a few cycles, typically it lasts about 4 to 7 years. But the recent cycle lasts about 10 years. And default rates as of this year pretty much stay well below the 2%. Okay, 4%, the 3% above there, the red dashed line is about average. It stays the low 2%. So we're still in a, this indicator says we're in a time period with very low default rates. And this benign credit cycle has been going on for 10 years. This part compares recovery rates of defaulted debt from 2014 to the second quarter of 2019. As you can see, the last column, overall recovery rates across all different securities is about 40% from 1978 to 2019. If you look at recent years, except for 2016 and 2015, they are well above the average over the history. Now, the issue with 2015, 2016 is quite, I would say, sector-driven. A lot of energy companies filed for bankruptcy when the energy price was low. And as you know, when commodity price is low, when this firm filed for bankruptcy, recovery rates are low. But overall, as you can see, in the last 3 years, from 2017 to today, the average recovery rates are well above historical average. This chart shows the high yield spread from the U.S. Federal Reserve. Right now, for high yield bonds, the spread over risk-free rate is about 4.8, almost 5%. So we're still, and this also indicates it's actually not costly to raise financing for risky companies. Next part, to measure liquidity of the market, we typically use the CCC issuance. This tells you, well, CCC rated firms are probably the lowest rated firms that can issue bonds in the public market. So if investors are willing to pay, willing to accept the issuers of these firms, it shows the high tolerance of risk by investors, means the market is quite liquid. As you can see, the CCC issuance has been going up and down, but we're on the high side of CCC issuance. This chart indicates that the markets are quite liquid in terms of the risk tolerance of investors. Okay, so if I do a quick summary, I think we're in an unprecedented duration of this benign cycle has been more than 10 years. And right now, default rates are well below historical average. Recovery rates are above average. And the yield spreads on high yield bonds are quite low. And the triple C issuance is quite active. So we're still in a benign cycle. And this cycle probably expected to last for another couple of years at least. Now, for the outlook, how do we predict this credit cycle, how long it will last, or when the next hit is? Well, it's very difficult to predict because there are a lot of external factors that may affect how the cycle turns out. But typically, we're looking for key statistics that help us predict when the cycle will end. So these are the key statistics, which includes the overall leverage of the non-financial firms in the U.S. and the high yield issuance, LBO risk factors, expected default rates for the next few years. Now, these statistics analysis are provided in my book, so I'll skip that. You're welcome to just take a look and to see what it would say about these factors. So part 2 of the book, as I mentioned, we cover the credit cycle, the current high yield markets, and then Professor Altman provides a 50-year retrospective on default prediction models. As you know, Professor Altman developed a Z-score model and the whole family of Z-score models starting in 1968. His most famous paper was published in 1968 to provide, I would say, the first metric on measuring the default risk of borrowers with high accuracy. This is a Z-score model. Well, it's been 50 years since the first Z-score model, and Professor Altman has developed many other models for different industries, for private companies, for different countries, and so on. So he'll provide this retrospective on how these models perform. So this is a very unique piece in the book. And then we'll also provide a chapter on sovereign risk. So in the end, we cover distressed investing. As I said, right now we're sitting on $3 trillion high yield bonds and leveraged loans. As I showed you guys earlier, there is a chart that shows in a recession or downturn, the default rates on the high yields are about 10%, which means 10% of $3 trillion, at least $3 trillion worth of securities will be in default state. So there'll be $300 billion worth of securities that will become distressed. And it will be the important investment, I would say, not tools, but securities or the targets that distressed funds will be targeting. So what is distressed investing? It's about investing in distressed or bankrupt companies with the goal of making a profit, of course. As a fund manager, hopefully you can locate attractive investments in distressed targets. Well, distressed companies are bad, of course. Bankrupt companies are worse. They're in a very bad state. It doesn't mean they're not good investments. But sometimes the securities could be trading at well below the true value due to many different factors. Okay, some investors that are part holders who have to sell their securities at a discount, and the markets are now very liquid. So if you're managing a fund that can be locked up for many years, there's no liquidity issue on the fund side. You can have a medium-term to long-term investment horizon. You can definitely lock in the profits from these factors. But for investing, this is not a simple task. Okay, so for a typical company, there are many different instruments outstanding, including first lien loans, second liens, senior bonds, senior secure bonds, non-secure bonds, junior bonds, equity. Now, what's the best instrument investing? That's a very important question. Okay, so there are different strategies. Some of the funds focus on the typical, we say, loan-to-own strategy. Their goal is to purchase that claims of distressed companies in the hope of becoming major owners when the restructuring wraps up. But others tend to buy low and sell high, so they buy underpriced securities regardless whether they're senior or junior. Their goal is to lock in a high IRR. Of course, the strategy involved many different dimensions, such as investing in senior, junior, security issued by the parent, operating company. There are also derivative instruments involved, such as CDS. So all these factors and instruments and corporate organization structure will play a role in distressed investing. So we have pretty much 3 to 4 chapters covering this very important topic. As I said, during the next downturn, we'll have at least $300 billion worth of distressed securities up for trading. This is going to be bigger than the last, before the last crisis. Okay, so that's part 2 of the book. We focus on investing in distressed securities, distressed debt markets, and in the very last chapter, we look at the modeling and the estimating of recovery rates. This is a unique chapter. We survey many studies published, and both reduced form and structural approach on estimating recovery rates. So, why is an important reference book? As I said, well, we have altogether, I believe we have 16 chapters now covering with different parts. Part 1 focuses on the introduction of leveraged finance markets, bankruptcy process, and the many key issues of the bankruptcy restructuring. The second part, we focus on the high yield markets and investing in distressed companies and some of the prediction models and the validations, prediction models, and so on. So in the book, we not only provide institutional details and the practice of restructuring, but also we provide the latest techniques for analyzing and predicting defaults and bankruptcies and how to invest in distressed firm securities. So the book has many up-to-date statistics on high yield markets, restructuring, bankruptcy, and distressed investing, and so on and so on. In addition to providing statistics and institutional details, our book also covers the most up-to-date research findings. So overall, I think hopefully, today's talk, during this short presentation, I can give you an overview of the leveraged finance markets and restructuring and why this is an important topic. As you probably know, most of my research is dedicated to this field. I think there are many aspects of the bankruptcy process of high yield markets that are now well understood. So I'll continue working in this field. But for this book, I believe it's useful reference for practitioners, academic researchers, policymakers, and students. So I hope this will become a topic of your interest, and one day you can grab a copy of the book and to learn more about it.
Thank you, Wei, for your presentation. We now have a little bit of time for the questions. If you guys use your right-hand side as the Q&A section or the chat function on the bottom of your screen, you have a great opportunity to ask your questions to Dr. Wang. So we'll be here for the next couple of minutes. Please feel free to ask any questions pertaining to the program, to the book. If you have any personal questions to Professor Wang, I hope. So we will be wrapping up right now. In case you have any further questions, you feel free to email Dr. Wang or visit his website, profwang.com, that you can connect him through his website as well. Thank you very much for joining us today.